Most professionals don't consciously decide to think in average ways. It happens gradually, almost invisibly, through constant exposure to shared environments, shared expectations, and shared definitions of what is considered reasonable. Over time, thinking begins to align with what feels acceptable rather than what is independently examined. This alignment creates a sense of stability. It also creates boundaries that are rarely questioned. Thinking in professional life is not purely analytical. It is social. Ideas are filtered not only through logic, but through how they will be received. A manager frames decisions in ways that align with leadership expectations. A consultant shapes recommendations that clients can comfortably accept. An employee calibrates opinions to match team dynamics. These adjustments are subtle, often unconscious. They reduce friction, they maintain coherence, and they reinforce a pattern where thinking stays within a predictable range. This is why average thinking does not feel limiting. It feels efficient. When your thoughts align with your environment, decisions become easier to make and easier to justify. You don't need to defend your position extensively. You don't need to tolerate disagreement. You move smoothly within the system. The reward is immediate. Less resistance, more acceptance, steady progress. There are clear real-world patterns that reflect this. Many professionals accept compensation adjustments based on internal salary bands without questioning external market value. Many follow standard career paths, education, employment, promotion, because those paths are widely validated. In investing, individuals often allocate capital into assets that are already popular, not because they have independently evaluated them, but because visibility creates perceived safety. During periods like the rapid rise of technology stocks or cryptocurrencies, participation increased not only due to opportunity, but due to collective reinforcement. The psychological driver is not lack of capability. It is risk minimization at a social level. Thinking differently introduces uncertainty. It may lead to disagreement. It may require explaining your reasoning without immediate support. The brain interprets this as friction. Aligning with average thinking removes that friction. It preserves belonging. It maintains predictability. The cost, however, is delayed. When outcomes in a system are unevenly distributed, thinking that remains within the average range tends to produce outcomes within that same range. This is not failure. It is convergence. If most professionals are optimizing for similar goals using similar frameworks, their results will cluster. To access outcomes outside that cluster requires thinking that, at some point, steps beyond what feels immediately safe. Institutional behavior offers a useful contrast. Large investment funds often act counter to prevailing sentiment at key moments, increasing exposure during downturns or reducing it during periods of excessive optimism. These decisions frequently look uncomfortable in the short term because they are not aligned with collective behavior at that moment. Yet, they are based on long-term structural reasoning rather than immediate validation. The ability to operate this way depends less on intelligence and more on tolerance for divergence. A similar pattern appears in career trajectories. Professionals who move into ownership structures, equity participation, partnerships, or building independent leverage often make decisions that initially appear unconventional. They may accept uncertainty, delay immediate rewards, or pursue paths that lack clear precedent within their peer group. These choices feel less stable, yet they are often where non-linear outcomes originate. Average thinking also shapes perception of possibility. If your environment normalizes a certain range of income, lifestyle, and career progression, that range becomes your reference point. You rarely question it because it appears sufficient and widely accepted. Without exposure to alternative models, expansion does not feel necessary. The limitation is not imposed externally. It is internalized through repetition. Over time, this pattern becomes part of identity. You begin to see yourself as someone operating within a certain structure, achieving within a certain range. Challenging that range requires more than different actions. It requires a shift in how you interpret what is reasonable, what is possible, and what is worth pursuing. The shift begins quietly. Not by rejecting everything that feels safe, but by recognizing where safety is guiding thinking more than analysis, where decisions are being made because they align with expectations rather than because they have been examined independently. This awareness creates distance, a small but important gap between default thinking and deliberate thinking. Within that gap, different possibilities start to appear, not immediately and not dramatically, but enough to begin questioning whether what feels safe is also what is optimal. And that question, when taken seriously, becomes the starting point for moving beyond the boundaries defined by average thinking. Next, we begin to understand why average thinking is so difficult to detect from the inside. It often feels like intelligence. When multiple smart, capable professionals arrive at similar conclusions, alignment creates a sense of correctness. Agreement signals validation. The more people converge on an idea, the more stable it appears. This is not because the idea is necessarily optimal, but because social reinforcement reduces perceived risk. In professional environments, consensus is frequently interpreted as sound judgment. Meetings that end in agreement feel productive. Strategies that align with industry norms feel responsible. Financial decisions that mirror peer behavior feel prudent. The underlying assumption is that collective intelligence reduces error. In many contexts, this is true. But in wealth-building contexts, where outcomes are unevenly distributed, consensus often produces average results by design. This is observable in investment behavior. During periods of market enthusiasm, capital flows concentrate into the same sectors, the same assets, the same narratives. Technology stocks during certain cycles, real estate during others, cryptocurrencies during phases of rapid adoption. Each wave is driven by a combination of information and collective reinforcement. The more participation increases, the more the decision feels validated. Yet, peak consensus often coincides with reduced future upside, precisely because expectations are already priced in. The same pattern exists in career decisions. Professionals tend to follow widely accepted pathways, prestigious degrees, recognized firms, predictable promotion tracks. These paths are not inherently flawed. They provide structure and reliability, but they also create convergence. When large numbers of highly capable individuals pursue identical trajectories, differentiation becomes limited. Compensation and opportunity distribute accordingly. Consensus also shapes risk perception. If everyone around you considers a decision reasonable, perceived risk decreases. If a decision lacks social reinforcement, perceived risk increases. This perception operates independently of actual probability. A professional may feel comfortable taking on significant financial commitments, large mortgages, lifestyle expansion, because peers are doing the same. At the same time, they may feel hesitant to pursue asymmetric opportunities, equity participation, independent ventures, because fewer peers validate those choices. The cognitive mechanism behind this is social proof. Humans infer correctness from group behavior, especially under uncertainty. In stable environments, this reduces error. In dynamic environments, it can create blind spots. If the group is converging on suboptimal assumptions, alignment amplifies those assumptions rather than correcting them. High-income professionals are particularly susceptible because they operate in environments filled with other intelligent individuals. The presence of intelligence increases confidence in collective decisions. If everyone in the room is capable, disagreement feels unnecessary. Yet capability does not eliminate bias. It can, in fact, reinforce it when similar training, incentives, and perspectives are shared. This dynamic explains why certain structural opportunities remain underexploited. Areas that lack immediate consensus, emerging industries, unconventional career paths, long horizon investments, often appear uncertain precisely because they are not socially validated yet. By the time consensus forms, the opportunity has frequently been partially absorbed. The early advantage belonged to those willing to think without reinforcement. There is also a reputational dimension. Aligning with consensus protects professional image. Diverging introduces exposure. If a consensus decision fails, responsibility is distributed. If a differentiated decision fails, responsibility feels personal. This asymmetry encourages conformity even among highly capable individuals. The professional chooses safety of alignment over uncertainty of independent positioning. The identity implication is subtle. Over time, repeated alignment trains the mind to equate agreement with correctness. Independent thinking begins to feel unnecessary or even inefficient. The professional becomes skilled at navigating within established framework, less practiced at questioning them. Wealth, however, often emerges from identifying gaps in those frameworks. The shift required here is not rejection of consensus, but awareness of its limitations. Consensus is useful for stability. It is less useful for asymmetry. Professionals who build disproportionate outcomes often maintain the ability to step outside collective agreement when necessary. They evaluate ideas on structural merit rather than social validation alone. This does not require constant contrarianism. Acting against consensus for its own sake is as unproductive as following it blindly. The distinction lies in independence of thought, the ability to hold a view that is not immediately reinforced, to tolerate temporary lack of validation, and to act when analysis supports it, even if consensus does not. Consensus feels like intelligence because it reduces uncertainty, but wealth accumulation often requires engaging with uncertainty before it becomes widely understood. When professionals recognize that agreement and optimality are not always aligned, they begin creating cognitive space. And within that space, different decisions become possible. Decisions not constrained by the need for immediate validation, but guided by long-term structural reasoning. Now the perspective shifts toward a consequence that rarely feels like a penalty while it is happening. Predictable decision-making. When thinking aligns consistently with established norms, decisions become legible to the system. They are easy to evaluate, easy to reward, and easy to replicate. This creates stability. It also creates limits. Most professional systems are designed around predictability. Compensation bands are structured around expected behavior. Promotion criteria are tied to measurable performance within defined roles. Investment frameworks are standardized for broad participation. These systems function efficiently when individuals behave in ways that can be anticipated. The more predictable your decisions, the easier it is for institutions to price your value. Predictability reduces uncertainty for the system. It also reduces upside for the individual. When your career moves follow expected sequences, your compensation growth tends to follow expected ranges. When your investment strategy mirrors widely adopted approaches, your returns tend to approximate market averages. When your thinking remains within accepted boundaries, your opportunities remain within those boundaries as well. This is not failure, it is alignment with system design. Most professionals who think predictably achieve stable, respectable outcomes. The cost is not visible in any single decision. It appears over time as a narrowing of range. Income grows, but within bands. Investments appreciate, but without asymmetry. Influence expands, but within defined hierarchies. The trajectory remains upward, yet bounded. There are observable examples of this dynamic across industries. Employees who follow standard promotion paths within large organizations often experience steady salary increases, but rarely access exponential compensation without shifting into ownership structures. Investors who allocate capital strictly according to common retail patterns, buying during optimism, selling during fear, diversifying reactively, often achieve returns close to market averages, but rarely exceed them significantly. The pattern is consistent. Predictable behavior produces predictable outcomes. The challenge is that predictability feels rational. It is reinforced by education, by corporate training, by financial advice frameworks. You are taught to optimize within systems, not necessarily to question their boundaries. Over time, the professional becomes highly effective at operating inside predefined parameters. The question of whether those parameters themselves limit potential rarely arises. Predictability also minimizes friction. Decisions that align with norms are easier to communicate. They require less explanation. They encounter less resistance. A career move that mirrors peer behavior feels justified. An investment aligned with popular sentiment feels validated. The absence of friction is interpreted as correctness, yet friction often signals differentiation, and differentiation is a prerequisite for disproportionate outcomes. There is also a compounding effect. Each predictable decision reinforces the next. Staying within established paths strengthens identity alignment with those paths. The professional begins to see themselves as someone who operates within certain boundaries. Over time, alternative strategies feel less accessible, not because they are impossible, but because they are unfamiliar. High-level wealth accumulation often requires breaking this chain of predictability at specific points. Not through random risk-taking, but through deliberate deviation where asymmetry exists. For example, choosing equity over salary at the right moment introduces variability, but also potential for nonlinear return. Concentrating effort in a niche domain rather than maintaining broad generalization can create scarcity-based leverage. Allocating capital counter to prevailing sentiment, when supported by analysis, can capture mispricing. These decisions are not frequent, they are inflection points, and they are often uncomfortable because they lack precedent within immediate peer groups. Predictable thinking would avoid them. Independent thinking evaluates them. The identity shift required here involves redefining what it means to be smart within professional systems. Smart is often equated with optimization, making efficient decisions within known frameworks. But at higher levels of wealth creation, smart increasingly means identifying when frameworks themselves become constraints. It means recognizing when predictability is preserving stability at the expense of expansion. Professionals who develop this awareness do not abandon structure entirely. They continue to operate effectively within systems where it makes sense. But they also identify moments where stepping outside predictability introduces disproportionate opportunity. These moments are not obvious. They require attention, patience, and tolerance for ambiguity. The hidden penalty of predictable decisions is not immediate loss. It is foregone upside. It is the difference between participating in growth and capturing leverage. Over years, that difference compounds. Two professionals with similar starting points can diverge significantly based on a small number of decisions that depart from the expected path. Recognizing predictability as both a strength and a limitation creates optionality. It allows professionals to remain stable where stability is beneficial and to deviate where asymmetry exists. And it is within those deviations, carefully chosen, strategically executed, that the boundaries of average outcomes begin to expand. Now we move deeper into one of the most persistent drivers of average thinking, risk aversion that presents itself as rational decision-making. For many professionals, especially those trained in analytical environments, decisions are framed through logic, data, and probability. This creates a sense of objectivity. Yet beneath that objectivity often sits a quieter force, the desire to avoid loss, uncertainty, or reputational exposure. Risk aversion is not inherently problematic. It protects against unnecessary downside. It stabilizes systems. It preserves accumulated capital. The issue arises when risk is evaluated asymmetrically, when potential losses are weighted more heavily than potential gains, not because of their actual probability, but because of how they feel. Behavioral finance research consistently shows that individuals experience losses more intensely than equivalent gains. This bias shapes decision-making even among highly educated professionals. In practice, this appears in subtle ways. A professional may decline an opportunity involving equity because the immediate salary reduction feels tangible, while the potential upside feels uncertain. An investor may avoid allocating capital during market downturns because price declines feel threatening, even when valuations become more attractive. A manager may avoid proposing a differentiated strategy because failure would be visible, while following consensus distributes responsibility. Each of these decisions can be justified rationally. The language used often emphasizes prudence, timing, or risk management. Yet when viewed collectively over time, they form a pattern of systematic underexposure to asymmetry. The individual avoids downside effectively, but also avoids scenarios where disproportionate upside is possible. Wealth accumulation, however, is rarely the result of avoiding all risk. It is the result of selectively engaging with risk that offers favorable asymmetry. There are clear real-world parallels. Venture capital firms invest in portfolios where most outcomes may fail, but a small number of successes generate outsized returns. Founders often accept years of uncertain income in exchange for potential ownership value. Early employees in high-growth companies trade salary certainty for equity participation. In each case, the decision involves accepting short-term uncertainty for long-term asymmetry. For many professionals, these choices feel misaligned with their identity. Stability has been reinforced as intelligence. Predictability has been rewarded. Deviating from that pattern introduces discomfort. The discomfort is often interpreted as evidence that the decision is risky in a negative sense. In reality, it may simply be unfamiliar. Corporate environments reinforce this bias structurally. Performance evaluation systems tend to penalize visible failure more than they reward invisible foresight. A decision that aligns with consensus and fails is rarely career-ending. A decision that diverges and fails can carry reputational cost. This creates an incentive structure where rational behavior favors alignment, even when independent positioning may offer better long-term outcomes. The financial system reflects similar dynamics. Many investors hold excess cash during uncertain periods because inaction feels safer. Yet historically, some of the strongest long-term returns have followed periods of maximum uncertainty, when asset prices are depressed. Acting in those moments requires not only analytical conviction, but emotional tolerance for discomfort. The identity implication is critical. When professionals consistently choose options that minimize immediate discomfort, their self-concept reinforces stability orientation. They begin to see themselves as cautious, measured, and prudent. These traits are valuable, but when they dominate decision-making, they can limit exposure to high-leverage opportunities. The shift required here is not abandoning rationality, it is refining it. True rationality includes evaluating both downside and upside symmetrically. It involves recognizing when emotional weighting distorts analysis. It means asking not only what could go wrong, but also what is the cost of not acting. Professionals who build substantial wealth often demonstrate this balance. They are not reckless. They are selective. They avoid unnecessary risk while deliberately engaging in situations where potential upside significantly exceeds potential downside. They accept that some discomfort is inherent in these decisions. Rather than eliminating discomfort, they learn to interpret it accurately. Over time, this recalibration changes behavior. Opportunities that once felt excessively risky begin to feel valuable. Decisions incorporate longer time horizons. Short-term volatility becomes less threatening relative to long-term positioning. The professional begins operating with a different relationship to uncertainty. Risk aversion disguised as rationality does not produce failure. It produces limitation. It narrows the range of outcomes to those that feel immediately comfortable. Breaking that pattern requires recognizing that comfort and optimality are not always aligned. And once that recognition stabilizes, the professional gains access to a broader set of decisions that may carry uncertainty, but also carry the potential for outcomes beyond the predictable range. Now we begin to understand why average thinking persists even among highly capable professionals. Thinking differently carries a social cost. Humans are not purely analytical systems. They are social systems first. Belonging, acceptance, and coherence within a group are deeply embedded drivers of behavior. When thinking begins to diverge from the group, it introduces subtle tension, not necessarily conflict, but misalignment. And misalignment, even when small, can feel psychologically expensive. In professional environments, this cost is rarely explicit. No one states that independent thinking is unwelcome. In fact, it is often encouraged rhetorically. Yet in practice, group dynamics favor alignment. Meetings converge toward shared conclusions. Language is softened to maintain agreement. Ideas that deviate too far from established norms require additional justification. The individual presenting them must carry the burden of explanation. This friction is not hostile, but it is noticeable. Over time, professionals learn to anticipate this friction. They adjust their thinking before expressing it. Instead of fully exploring differentiated perspectives, they refine ideas to fit within acceptable boundaries. This adjustment is efficient. It reduces resistance. It preserves relational harmony. It also gradually narrows cognitive range. The social cost extends beyond formal settings. Peer groups influence perception continuously. Conversations about compensation, investments, career progression, and lifestyle create implicit benchmarks. If your decisions deviate significantly from these benchmarks, they invite scrutiny. Not necessarily criticism, but questioning. Why are you doing this? Is that safe? Is that necessary? These questions are framed as concern, yet they reinforce conformity. There are clear, real-world manifestations of this dynamic. Professionals who choose unconventional career paths, leaving established firms to join smaller ventures, prioritizing equity over salary, relocating for asymmetric opportunity, often face skepticism from peers who prioritize stability. Investors who hold positions during downturns may be questioned by those reducing exposure. Individuals who maintain lower lifestyle inflation despite rising income may appear conservative relative to their environment. None of these reactions are malicious. They are reflections of shared norms. Groups maintain coherence by reinforcing common behavior. Divergence introduces uncertainty not only for the individual but for the group observing it. If one member operates outside the norm, it implicitly questions the validity of the norm itself. This can create subtle resistance. The professional sensing this resistance faces a trade-off: align with the group and maintain ease of interaction, or diverge and accept increased cognitive and social effort. Most choose alignment most of the time. It is efficient, it is comfortable, it is rewarded through smooth interactions and predictable progression. The cost, again, is delayed. Wealth accumulation at higher levels often requires decisions that are not immediately validated by one's immediate environment. Early-stage investments, long-horizon career bets, concentrated efforts in niche domains, these actions may not receive reinforcement until much later, if at all. The individual must operate without continuous social confirmation. This requires a form of independence that is not purely intellectual, but emotional. The ability to tolerate not being immediately understood, the ability to hold a position that others may not share, the ability to continue executing without external validation at each step. These capacities are rarely developed deliberately, yet they become critical at higher levels of decision-making. There is also a reputational dimension. Professionals often build identities around being reliable, collaborative, and aligned. Diverging too frequently or too visibly can appear inconsistent with that identity. To preserve reputation, individuals may limit the extent of their differentiation. They remain within a range that feels acceptable, even if broader opportunities exist outside that range. The identity shift required here involves redefining belonging. Instead of deriving belonging exclusively from immediate peer alignment, it becomes anchored in internal coherence. The professional begins to prioritize alignment between their thinking and their long-term objectives over alignment with current group norms. This does not eliminate collaboration or social connection. It changes the source of validation. As this shift develops, behavior changes subtly. Professionals still participate in group processes, but they no longer rely on them to define their thinking. They express differentiated views when necessary, without overcompensation. They accept that some ideas will not be immediately understood. They maintain relational stability while allowing cognitive independence. Over time, this balance creates advantage. The individual remains integrated within networks while accessing perspectives beyond them. They benefit from both stability and differentiation. Their decisions are informed by the environment, but not constrained by it. The social cost of thinking differently never disappears entirely. But when professionals learn to tolerate it, the constraint weakens. And with that, a wider range of decisions becomes available, decisions that may feel less comfortable in the moment, but carry the potential to move beyond the boundaries defined by average thinking. Next, we move deeper into a subtle trap. Experience itself can reinforce average thinking. Over time, professionals accumulate evidence that their current way of thinking works. Careers progress, income increases, decisions feel validated. This creates confidence, but it also creates inertia. When past patterns produce acceptable outcomes, questioning those patterns feels unnecessary. Experience is often treated as an unquestioned asset. In many contexts, it is. It improves judgment, reduces error, and increases efficiency. Yet experience is also path-dependent. It reflects the environments, incentives, and norms within which it was built. If those environments reward predictability and alignment, then experience reinforces those behaviors. The professional becomes highly skilled at operating within a particular range and less practiced at operating outside it. This is observable in career progression. Early success often comes from mastering existing systems, understanding expectations, delivering consistently, navigating organizational dynamics. These skills are valuable, but they are optimized for performance within structure, not necessarily for creating new structures. As professionals advance, they may continue applying the same thinking patterns, even when the level of leverage required has changed. In investing, a similar pattern appears. Individuals who experience steady gains in stable markets may develop confidence in strategies that work under those conditions. When market regimes shift, increased volatility, changing interest rates, new asset classes, Prior experience may no longer map cleanly onto current dynamics, yet the mind tends to rely on familiar frameworks because they have been validated before. There are well-documented examples of this. Investors who became successful during long bull markets often struggled to adapt during downturns, not due to lack of intelligence, but due to over-reliance on prior experience. Similarly, professionals who built careers in stable corporate environments may find it difficult to navigate less structured, high-variance opportunities, even when those opportunities offer greater upside. The underlying mechanism is reinforcement learning. The brain encodes patterns that lead to positive outcomes and repeats them. Over time, these patterns become default strategies. The more they are reinforced, the less they are questioned. What once required deliberate thought becomes automatic. This creates a paradox. The very experience that enables success can limit expansion because it narrows the perceived range of viable strategies. The professional begins to equate familiarity with correctness. New approaches feel risky not necessarily because they are objectively inferior, but because they fall outside established experience. There's also a reputational dimension. Experienced professionals are expected to be consistent. They are valued for their ability to apply known frameworks reliably. Deviating from those frameworks can feel like undermining their own credibility. As a result, they may continue operating within familiar patterns even when conditions suggest adaptation. The cost appears gradually. Opportunities that require different thinking are overlooked or dismissed. New environments feel less attractive because they do not align with prior success models. The professional remains effective within a defined range, but does not expand beyond it. The identity implication is significant. Experience becomes part of self-definition. This is how I operate. This is what works. These statements provide clarity, but they can also create rigidity. When identity is tied to established patterns, changing those patterns feels like changing the self. The shift required here involves separating experience from identity. Experience becomes a tool, not a constraint. It informs decisions without defining them. Professionals begin to ask not only what has worked before, but also what conditions are different now, and what strategies are required for the next level of leverage. This shift introduces flexibility. Familiar patterns are still used where appropriate, but they are no longer applied automatically. New approaches are evaluated based on structure rather than dismissed due to unfamiliarity. The professional becomes capable of updating their thinking as environments evolve. Over time, this adaptability compounds. Instead of being limited by past success, the individual builds on it. They retain the advantages of experience, pattern recognition, efficiency, judgment, while expanding the range of strategies they are willing to consider. Experience should reduce error, not limit possibility. When professionals recognize that past success does not guarantee future optimality, they create space for evolution. And in that space, thinking begins to move beyond the boundaries defined by what has worked before toward what could work at a larger scale. Now the perspective shifts toward a quieter mechanism that sustains average thinking: unexamined assumptions. Most professional decisions are not made from first principles. They are made from inherited frameworks, beliefs about careers, money, risk, and success that are rarely questioned because they appear self-evident. These assumptions simplify decision-making. They also define its boundaries. Assumptions form early and solidify through repetition. Certain ideas become embedded. Stable careers are safer than uncertain ones. Diversification always reduces risk. Higher income automatically leads to greater wealth. Promotions equate to progress. Each of these contains elements of truth. The limitation arises when they are applied universally without context. In corporate environments, for example, the assumption that upward progression within hierarchy is the primary path to success leads many professionals to optimize for titles rather than leverage. They pursue promotions that increase responsibility, but not necessarily ownership. Compensation grows linearly. The assumption remains unchallenged because it is widely accepted. Yet alternative paths, equity participation, independent advisory roles, building niche expertise, may offer different risk-return profiles that are not considered simply because they fall outside default assumptions. In investing, assumptions are equally influential. Many individuals believe that frequent monitoring improves outcomes, or that reacting to market changes is a form of prudent management. Data across decades suggests otherwise for most participants, yet the assumption persists because it aligns with intuition. Similarly, the belief that diversification alone ensures safety can lead to overdistribution of capital without consideration of return concentration. The framework is applied, but not examined. These patterns are reinforced by information ecosystems. Financial advice, corporate training, and educational systems often present generalized principles designed for broad applicability. These principles are useful at scale, but they are not always optimized for individual asymmetry. When applied without reflection, they produce convergence. The challenge is that assumptions rarely feel like assumptions. They feel like facts. They operate beneath conscious awareness. Professionals do not actively choose them, they inherit. As a result, questioning them can feel unnecessary or even inefficient. Why reevaluate something that appears to work? The answer lies in distribution of outcomes. If most individuals operate under similar assumptions, then outcomes will cluster accordingly. To access outcomes outside that cluster, some assumptions must be examined. This does not mean rejecting all conventional wisdom. It means identifying where it applies and where it may limit potential. There are observable examples of this process. Professionals who question the assumption that income must come primarily from employment often explore ownership structures earlier. Investors who question the assumption that volatility should always be avoided may reframe downturns as entry opportunities. Individuals who question the assumption that career paths must be linear may design non-linear trajectories that increase leverage over time. Questioning assumptions introduces cognitive friction. It requires slowing down automatic decision-making. It requires gathering information beyond familiar sources. It may lead to conclusions that differ from peers. This friction is often enough to discourage the process. Average thinking persists not because alternatives are unavailable, but because examining assumptions requires effort and tolerance for uncertainty. There is also a psychological cost. Assumptions provide stability. They reduce the need for constant evaluation. When they are questioned, stability decreases temporarily. The professional must navigate ambiguity. This can feel inefficient compared to following established frameworks. Yet that temporary instability is often where new insight emerges. The identity shift required here involves moving from passive acceptance to active evaluation. Instead of inheriting frameworks, the professional engages with them. They ask, under what conditions does this assumption hold? When does it fail? What alternative models exist? This approach does not discard structure, it refines it. Over time, this refinement compounds. Decisions become more context-specific. Strategies become more tailored. The professional operates with a clearer understanding of why they are choosing a particular path, rather than simply following it. The cost of not questioning assumptions is not immediate error. It is constrained possibility. It is the gradual alignment with outcomes produced by those assumptions. When professionals begin examining the frameworks guiding their decisions, they expand the range of options available to them. And within that expanded range lies the potential to move beyond average outcomes into more deliberate, differentiated trajectories. Now we begin to understand a pattern that is often praised but rarely examined: being consistently reasonable. In professional environments, reasonableness is associated with maturity, balance, and sound judgment. It reflects measured decisions, controlled risk-taking, and alignment with established expectations. These qualities are valuable. They also create a specific type of trajectory, one that is stable, predictable, and often bounded. Reasonableness optimizes for avoiding mistakes. It minimizes downside exposure. It ensures that decisions can be justified within accepted frameworks. A reasonable professional negotiates within expected ranges, invests according to common guidance, and progresses through recognizable career paths. Nothing appears excessive. Nothing appears reckless. The result is consistency. The hidden cost lies in opportunity selection. Many high-leverage opportunities appear unreasonable at the moment they are encountered. Accepting equity instead of guaranteed compensation, concentrating effort in a niche rather than diversifying broadly, allocating capital during periods of uncertainty, or stepping outside established career tracks, these decisions often lack immediate consensus support. From a reasonable perspective, they may seem unnecessary or disproportionately risky. Consider early-stage company participation. Joining a smaller, less established organization with significant equity potential can appear less reasonable than remaining in a stable, well-compensated role. The salary is lower, the outcome is uncertain. Yet in certain cases, the asymmetry of potential return is substantial. The decision to participate requires tolerance for outcomes that cannot be fully predicted or immediately justified. Similarly, in investing, purchasing assets during periods of negative sentiment often feels unreasonable. Prices are declining, news flow is unfavorable, peer behavior trends toward caution. Yet historically, some of the strongest long-term returns have originated from periods where prevailing sentiment was negative. Acting in those moments requires stepping outside what feels collectively reasonable. Reasonableness is also shaped by social comparison. Professionals calibrate decisions relative to peers. If most individuals in your environment are following similar patterns, deviating significantly can feel disproportionate. The question shifts from, is this structurally advantageous, to is this consistent with what others are doing? This reframing prioritizes alignment over optimization. There is also an emotional component. Reasonable decisions reduce cognitive strain. They are easier to explain, easier to defend, and easier to live with in the short term. Unreasonable decisions, in the sense of being unconventional, introduce ambiguity. They require sustained conviction without immediate validation. For many professionals, the psychological cost of ambiguity outweighs the potential financial benefit. The cumulative effect is subtle. Each reasonable decision appears correct in isolation. Over time, however, consistently choosing the most justifiable option can limit exposure to asymmetric outcomes. Income grows steadily but within predictable ranges. Investments perform reliably but without significant outperformance. Career progression remains stable but leverage remains moderate. There are observable contrasts in how different groups approach this trade-off. Institutional investors, for example, often deploy capital in ways that may appear counterintuitive in the short term, but are grounded in long-horizon frameworks. Entrepreneurs frequently pursue opportunities that lack immediate validation but offer scalable upside. These approaches involve a calibrated departure from conventional reasonableness. The identity implication is important. Many professionals take pride in being measured and rational. These traits are reinforced throughout education and career development. Shifting toward decisions that occasionally appear unreasonable can feel inconsistent with this identity. The concern is not only about financial risk, but about maintaining self-coherence. The shift required here is not abandoning reason. It is expanding its definition. Reasonableness must include evaluation of opportunity cost, not just risk avoidance. It must account for asymmetry, situations where potential upside significantly exceeds potential downside, even if those situations lack immediate consensus validation. Professionals who make this adjustment begin to differentiate between decisions that are safe and decisions that are optimal. They continue to operate reasonably in contexts where stability is beneficial, but they also identify moments where strict adherence to reasonableness may exclude high-leverage opportunities. In those moments, they allow for calibrated deviation. Over time, these deviations matter disproportionately. A small number of decisions that depart from average patterns can alter long-term trajectory significantly. The professional remains largely stable while selectively engaging with asymmetry. The opportunity cost of staying reasonable is not visible in daily life. It accumulates quietly in the form of paths not taken and leverage not accessed. Recognizing this cost does not require abandoning caution. It requires acknowledging that optimal outcomes sometimes lie just beyond the boundary of what feels immediately reasonable. Now the perspective shifts toward how average thinking does not usually manifest as a single decision, but as a gradual drift. There is rarely a moment where a professional consciously chooses an average outcome. Instead, a series of reasonable, consensus-aligned decisions accumulate over time. Each step feels justified. The trajectory appears stable. Only in hindsight does the pattern become visible. Drift occurs because most decisions are made locally, not globally. Professionals evaluate choices based on immediate context: the next role, the next investment, the next financial move. Each decision is optimized for short-term coherence. Over time, however, these local optimizations shape a broader trajectory. If each decision aligns with existing norms, the overall path converges toward average outcomes. This is observable in career progression. A professional may accept a promotion because it aligns with expected growth, then another because it continues that path, and another because it maintains momentum. Each decision is rational within its context, yet the cumulative effect may be a deeply embedded position within a system that offers limited leverage relative to alternatives that were never explored. In investing, similar patterns emerge. Allocations are adjusted incrementally in response to market conditions, peer behavior, or widely accepted advice. The portfolio evolves through small, reasonable changes. Over time, it reflects a consensus strategy rather than a differentiated one. Returns approximate the average, not because of a lack of discipline, but because of consistent alignment with common frameworks. Drift is reinforced by the absence of negative feedback. Average thinking does not produce immediate failure. It produces acceptable results. Income grows, investments appreciate, lifestyle improves. There is little incentive to question the trajectory because it appears to be working. The professional remains engaged, productive, and successful by conventional standards. The challenge is that acceptable outcomes can mask constrained potential. Without clear signals of underperformance, there is no trigger for reassessment. The professional continues along a path that feels efficient, unaware that alternative trajectories could produce different scales of outcome. There are real-world examples of this dynamic in compensation structures. Employees who remain within standard corporate paths often see steady salary growth, yet may not realize the magnitude of difference compared to peers who transitioned into ownership roles, profit-sharing structures, or high-leverage positions. The divergence becomes apparent only after several years, by which point the gap reflects compounded decisions rather than a single missed opportunity. Drift also affects time allocation. Small decisions about how time is spent, responding quickly, attending meetings, consuming information, shape cognitive patterns. Over time, these patterns influence the ability to engage in deep work or strategic thinking. The professional becomes efficient within a reactive framework, but less practiced in long-horizon planning. The identity implication is subtle. As decisions accumulate, identity adapts to the path taken. The professional begins to see their trajectory as natural. Alternative paths feel increasingly distant, not because they are unavailable, but because they no longer align with established self-perception. The drift becomes self-reinforcing. The shift required here involves introducing periodic discontinuity in thinking. Instead of evaluating each decision in isolation, professionals step back to assess trajectory as a whole. Questions change from, is this the right next move, to what path am I compounding into? And does this path align with the scale of outcome I actually want? This type of reflection is not frequent in most environments because it disrupts momentum. It introduces uncertainty. It may challenge decisions that have already been made. Yet without it, drift continues unchecked. Professionals who interrupt drift periodically often identify misalignments early. They recognize when their trajectory is converging toward outcomes that, while stable, do not match their potential. They adjust selectively, not by abandoning structure entirely, but by introducing differentiated decisions at key points. Over time, these adjustments alter compounding direction. The path begins to diverge from average patterns, not dramatically at first, but progressively. The slow drift into average outcomes is not the result of poor decisions. It is the result of unexamined accumulation of reasonable ones. Recognizing this pattern creates the possibility of intentional course correction. And in long-term wealth and career trajectories, small corrections made early compound far more powerfully than large corrections attempted later. Now we move deeper into a distinction that is often overlooked. Intelligence and independent thinking are not the same. Many professionals operate at a high level of analytical capability. They process information quickly, understand complex systems, and make sound decisions within established frameworks. Yet those frameworks themselves are rarely questioned. Intelligence is applied efficiently, but not independently. Modern professional systems are highly optimized for this type of intelligence. Education trains individuals to solve defined problems. Corporate environments reward execution within structured roles. Financial systems provide models and frameworks that guide decision-making. Over time, professionals become exceptionally skilled at operating within these systems. They learn what works, what is rewarded, and how to navigate efficiently. The limitation emerges when intelligence becomes dependent on structure. If thinking is always applied within predefined boundaries, it rarely challenges those boundaries. The professional becomes an expert operator rather than a designer of new pathways. This distinction is subtle, but it has significant implications for wealth creation. Operator intelligence optimizes existing processes. It improves efficiency, reduces error, and enhances performance within known systems. Designer intelligence questions assumptions, identifies gaps, and creates new structures where different outcomes are possible. Both are valuable. However, higher levels of wealth accumulation often correlate with the latter, the ability to operate beyond given frameworks rather than solely within them. There are observable examples of this distinction. Many high-performing employees generate substantial value within organizations, yet remain compensated within structured ranges. Their intelligence is recognized and rewarded, but within predefined limits. In contrast, individuals who redesign systems, founders, investors, strategic decision-makers, often capture disproportionate value because they operate at the level where frameworks are created or altered. The same pattern appears in investing. Like an individual may understand financial models, market dynamics, and asset allocation strategies thoroughly. They may execute these strategies effectively and achieve solid returns. Yet, without independent positioning, identifying mispriced opportunities, holding conviction against prevailing sentiment, structuring capital allocation uniquely, outcomes tend to align with averages. This is not a failure of intelligence. It is a reflection of where intelligence is applied. When it remains within consensus frameworks, it produces consensus outcomes. To move beyond that, intelligence must be paired with independence, the willingness to evaluate, question, and occasionally diverge from established models. There is also a psychological component. Independence introduces responsibility. When operating within frameworks, decisions are supported by precedent. When operating independently, outcomes feel more directly attributable. This increases perceived risk. Many professionals unconsciously prefer environments where responsibility is distributed rather than concentrated. Corporate structures reinforce this preference. Decision-making is often collaborative, risk is shared, accountability is diffused. These features make large organizations stable and efficient. They also make independent thinking less necessary for success within them. Professionals can progress significantly without ever needing to depart from established frameworks. The identity implication is important. Individuals begin to see themselves as effective within systems. Their confidence is tied to performance inside those systems. Shifting toward independent thinking can feel like stepping outside proven competence. The concern is not lack of ability, but lack of validation. The shift required here involves expanding the role of intelligence. Instead of applying it only to optimize within frameworks, professionals begin applying it to evaluate the frameworks themselves. They ask, why does this system operate this way? Where are its limitations? What alternative structures could produce different outcomes? This shift does not require immediate action. It begins with observation, recognizing when thinking is guided by inherited models rather than independent analysis. Noticing where conclusions are reached quickly because they align with existing frameworks. Introducing small moments of questioning where assumptions are typically accepted. Over time, this practice builds cognitive flexibility. Intelligence becomes less dependent on structure and more capable of operating without it. Professionals begin identifying opportunities that are not immediately visible within standard frameworks. They develop the capacity to design rather than only execute. Intelligence without independence produces efficiency. Intelligence with independence produces leverage. And in long-term wealth creation, leverage, the ability to generate disproportionate outcomes from selective decisions, is what ultimately differentiates trajectories that remain within average ranges from those that extend beyond them. Next, we move toward the internal mechanism that makes all of this possible: independent thinking as a discipline. not as a personality trait or intellectual stance, but as a practiced way of engaging with decisions. For most professionals, thinking is reactive by default. Information arrives, frameworks are applied, conclusions are formed quickly. Independent thinking slows this process. It introduces a deliberate pause between input and conclusion. This pause is where differentiation begins. Instead of immediately accepting prevailing interpretations, the professional examines structure. What assumptions are embedded here? What incentives are shaping this narrative? What outcomes does this framework tend to produce? These questions are not asked continuously. That would be inefficient. They are applied selectively at points where decisions have long-term impact. Independent thinking is quiet because it often occurs before expression. It does not require constant disagreement. It requires internal separation from default conclusions. In meetings, this may appear as measured responses rather than immediate alignment. In investing, it may appear as holding positions through periods where sentiment shifts. In career decisions, it may appear as evaluating opportunities beyond visible compensation or title progression. There are observable patterns among professionals who develop this discipline. They consume information differently. Rather than increasing volume, they increase depth. They prioritize primary sources over summaries when decisions matter. They are less reactive to headlines and more attentive to underlying structures. This does not make them slower. It makes their decisions less dependent on external noise. Independent thinking also requires tolerance for incomplete validation. When a decision is not immediately reinforced by peers or data, uncertainty increases. The professional must rely on their reasoning process rather than external confirmation. This is not comfortable initially. Most environments reward speed and agreement. Deliberate thinking can feel inefficient in comparison. The financial implications are subtle but significant. In markets, independent thinking allows for holding positions based on structural conviction rather than short-term sentiment. This reduces reactive trading and improves alignment with long-term compounding. In careers, it allows for selecting roles based on leverage potential rather than immediate recognition, leading to different trajectories over time. There is also a restraint component. Independent thinkers often act less frequently, not more. They wait for clarity. They avoid unnecessary adjustments. This restraint is not passivity. It is selectivity. Decisions are made when conditions align with internal reasoning, not when external pressure increases. The identity shift required here involves redefining what it means to be decisive. Decisiveness is often associated with speed. In this context, it becomes associated with clarity. The professional is willing to delay action until thinking is coherent. This can appear slower in the short term, but often leads to more stable outcomes in the long term. Developing this discipline does not require isolation from others. It requires internal independence within collaborative environments. Professionals continue to engage with peers, learn from collective insight, and participate in shared decision-making. The difference lies in how conclusions are formed. External input informs thinking but does not replace it. Over time, independent thinking compounds. Each decision made with clarity reinforces the process. Confidence shifts from external validation to internal coherence. The professional becomes less reactive to changing narratives and more consistent in their approach. This consistency is valuable in uncertain environments. When others adjust rapidly in response to new information, independent thinkers maintain stability until structural change is evident. This reduces unnecessary movement and preserves alignment with long-term strategy. Independent thinking is not dramatic. It does not require constant opposition. It operates quietly, shaping decisions before they are visible. And because it operates at the level of process rather than outcome, its impact accumulates gradually. In the context of wealth and professional trajectory, this discipline creates separation, not immediate, but progressive. While average thinking follows external signals, independent thinking filters them. Over time, that filtering produces different decisions. And different decisions compounded across years produce different outcomes that extend beyond the range defined by what feels immediately safe or collectively validated. Now we arrive at the integration point. Average thinking persists because its costs are delayed while its benefits are immediate. Safety feels good in the present. Alignment reduces friction. Predictability provides stability. Decisions are easy to justify, easy to communicate, and easy to live with day to day. There is no obvious signal that anything is wrong. The cost appears gradually, not as failure, but as limitation. Over time, the professional begins to notice subtle gaps. Income has grown, but not beyond certain thresholds. Investments have performed, but without significant outperformance. Career progression has been steady, but leverage remains moderate. These observations rarely trigger immediate concern because everything appears functional. Yet the difference between what is and what could have been begins to emerge. This realization often comes through comparison across longer time horizons. Peers who took different paths, accepted uncertainty, pursued ownership, concentrated effort, tolerated divergence, begin to show non-linear outcomes. Their trajectories may have appeared unstable earlier. Over time, they reveal disproportionate results. The contrast is not immediate. It becomes visible only after compounding has had time to operate. At that point, the cost of safety becomes clearer. It is not the absence of success, it is the absence of scale. It is the recognition that many decisions were optimized for short-term comfort rather than long-term leverage. The professional sees that stability was preserved, but expansion was limited. Importantly, this recognition is not about regret. It is about awareness. The same patterns that produced average outcomes can continue indefinitely if unexamined. Or they can be adjusted. The trajectory, even after years, remains flexible. But the earlier the shift occurs, the greater the compounding effect. The core insight is this: safety in thinking is not neutral. It shapes outcomes. When thinking consistently aligns with what feels secure, decisions align with what is widely accepted. Widely accepted paths produce widely distributed outcomes. To move beyond that distribution requires occasional departure from safety, not recklessly, but deliberately. This does not mean abandoning stability entirely. Stability has value. It provides foundation. The shift lies in how safety is used. Instead of being the default filter for all decisions, it becomes one variable among others. Professionals begin asking not only, is this safe, but also what is the cost of staying within safety? As this question becomes integrated, behavior changes subtly. Decisions are evaluated over longer horizons. Opportunity cost becomes more visible. Asymmetry is considered more carefully. The professional begins to allow for calculated divergence in areas where potential upside justifies uncertainty. Over time, these adjustments compound. A small number of differentiated decisions can alter trajectory meaningfully. The individual does not need to become entirely contrarian. They need to be selectively independent, stable where stability is beneficial, and divergent where leverage exists. This balance creates a new form of safety, not the safety of conformity, but the safety of intentionality. The professional is no longer relying solely on external validation to guide decisions. They are operating with a clearer understanding of trade-offs. This clarity reduces hidden costs because decisions are made consciously rather than by default. Average thinking feels safe because it minimizes immediate discomfort. But in long-term wealth and career trajectories, the greater risk is often invisible, the gradual narrowing of potential. Recognizing this shifts the focus from avoiding short-term uncertainty to managing long-term opportunity. If this perspective feels familiar, it may be because you recognize moments where decisions were shaped more by comfort than by possibility. Here at Mindful Wealth, we continue exploring these quiet patterns that influence income, identity, and long-term outcomes. If this way of thinking aligns with you, consider subscribing and sharing this conversation with someone who values clarity over convention. Because the most meaningful shifts are often not dramatic. They begin with seeing clearly what was previously assumed to be safe.